Alright guys, so in this one we're going to be going up to chapter 4 in the Word document. Um, we're just basically going to be talking about what is supply and demand, what is the concept, price action, how to identify supply and demand, and how to draw supply and demand zones. So, what is supply and demand? Well, what demand is, what I have up here, is when no more willing institutional sell orders, only buy orders exceed the sell orders, and then therefore price moves up. Same thing for supply, but vice versa, is when no more willing institutional buy orders, only sell orders exceed the buy orders, and then therefore price moves down, right? So if we understand that the markets are dominated by the banks and institutions, don't you think it would be a smart idea to be on the side of the banks and institutions? And then you might be thinking, well, how do we know where they're buying and selling? Well, that's the beauty with the internet. Nowadays, with charts, you can look at a chart and they leave footprints. Previously, history, repeats itself. Not all the time, but we're willing to take a probability-based chance that they're going to be buying and selling in the same positions, because if they saw value at a certain level, why shouldn't we see the same value the next time it comes directly into the zone? So the only reason why prices went up from here is, well, there was more buyers and sellers, but this is a daily chart. Anybody that's moving this is not retail traders that are making this move. This is banks, institutions. So if we know that they saw value in this location here before, when price came back down like it did here, why would we be looking to sell? We should be looking for buying. If they saw value here, maybe they didn't get all their orders filled. These guys can't just go into the market and drop, $50 billion or so much money into the market, because it's just going to skyrocket up, right? So maybe they only got rid of half their orders. That's how brokers make an extra commission, because if they get told, hey, we need to sell, let's not use big numbers. Let's just say 1,000 orders, because it's just simple. It's smaller. But say they need to buy 1,000 orders at this price, and the broker is like, okay, you get an extra commission base if you can sell it in this realm of prices. So the broker is going to be buying anytime when prices comes into this area. Maybe he got rid of half his orders in this move up, so next time when price comes down again, he's getting another half filled, or he got all his filled, right? But once price finally breaks it, the only reason why price breaks it is because, well, there was no more institutional buy orders there. They were all filled up. There wasn't a single buyer that was willing to push it up higher. The sellers took control, and there was more sellers. It's the same thing for supply too. All right. If we understand that the markets turn at price levels where the institutionals are buying and selling, that's where we should be looking, right? And we understand that the banks, they make these moves in the markets, so we should be trying to be on their side of the markets. That's why we're going to have multiple time frame analysis. It's all important. We're going to be getting into that. But that's basically what the principle is, what's the concept, and what's the price action, because we need to understand where these banks are headed. So if we actually look at the Word document, like I was just talking to you about, if we have, say, what is this, 2,000 buy orders, and we only have 500 sell orders here, well, the buy orders clearly exceed. They're going to take up all these sell orders, and we only have buy orders left here. So what has to happen? There's no more sell orders, so therefore price has to move up in order to find the next stack of sell orders. So here in this drawing that you guys have been looking at is the exact same thing. Here we have 1,000 buy orders. Price is shot all the way up. So next time when price comes back in here, why shouldn't we not expect, but let's take a probability chance that they're going to see the same value in this, because maybe like this price moves up so fast, so they clearly saw value in here. So we believe that they should see the same value again. Now you might be asking hey, what about this area? Well, it just didn't work out. You could say there was a little demand zone here. Prices came up for a bit and then dropped. You could say this demand was a rally-based rally. Price came down, tested it once, tested it twice, tested it 3 times, and went out, right? So if we go back to this drawing and talk about it, it was tested once, rallied up, came back down, got filled with another 500 orders, let's just say, rallied up, and then there was just no more sell order, no more buy orders, so prices had to fall down in order to find the next stack of buy orders. So here was the next stack of buy orders, a rally-based rally. We're going to get into that about how to identify and how to draw them next. But here was the next demand area. So you can see price came down, got filled up. The institutions were buying here, went up, came into the supply, drop-based drop, and then price took control again and dropped. Right? So is every zone work? Is this like, if it comes into a supply zone, is it going to work? No. We never really know if they're going to be buying or selling there. The broker or whoever's selling could be on a lunch break with his buddies, and he could just be out of the office, and he was going to make that move down or up, but he was just simply out of the office. All right. So that's really kind of the concept. What is the supply and demand? And just basically the price action. We need to understand what's going on. Where are the banks located? They leave footprints here in the markets, and we're trying to find where they're located by these big moves in the market so we can capitalize when price comes down into the area. So here in the supply and demand methodology, all we look for is 4 patterns. We can use indicators. There's nothing wrong with using indicators, but if you're just getting started out with the methodology, I strongly suggest just staying away from indicators, just really using price action and these 4 patterns. Once you go on and understand the concept and all that, that's okay to use EMAs, Fibonacci's, support and resistance, other like head and shoulders, other patterns, price patterns, or chart patterns, whatever you want to call them. That's okay. But if you're going to use them, try to be very consistent and make sure that you want to be looking for that same setup every single time, because we're just trying to be really a one-trick pony in trading, because everybody's going to have a different trading system, different plan, different risk management, different rules, and we're all going to create our own plan based around our beliefs in the market, our pros and our cons of ourselves, right? So everybody's going to trade a little bit different. So you can move into those other markets or those other indicators, I want to say, but for right now, I would really suggest just keeping them bare naked. I personally don't use anything. I just use strictly price action and supply and demand, these 4 patterns. So the demand is rally-based rally and a drop-based rally. All right, so what you'll notice is that all these patterns have one thing in common, and that's a base, right? Before they all have an imbalance and a base. So if we want to find a demand zone, we need to find the imbalances. So in order to find a demand zone, we have to always go below current price and to the left, because demand is always going to be below current price and to the left, and supply is always going to be above current price and to the left. Nothing's going to be to the right because it hasn't shown itself. All right. So if we look at price right now, let's just move this. Let's move this over here. If we look at price right now, and if we're going to find demand, we have to go below current price and to the left. So right here we have a demand zone. And why is it we're going to need this? Why is it a demand zone? Well, if we look at it, it's a big move out. These are moves that we want to see in the market. We know that a bank or institution made this move right here. So here is the drop. You can see how it based and a rally. And I'll show you guys a little trick with this. If we actually go to indicators, and I really don't suggest you guys use this for everything. It's called a 50% body candle, and it's going to help you guys identify them. But I don't want to say like every base is a base in a candle, and like in a supply or demand zone. It just really stands out, right? So if it will change the color to white or any color you want, but it really just helps you identify the base in the market. So here is like a drop-based rally. Right here is a drop-based drop. All right, drop-based drop, rally-based drop, and a drop-based rally. That's a little trick you could use, but I don't suggest using that all the time. But maybe if you're having a hard time identifying, you can. But just because it's a base in a candle doesn't mean you want to be using it. I suggest staying away from it, but it is a little trick. So if we're going to identify demand, we're always going to have to go below current price and to the left. And we're looking for the big rally in price for demand. So right here is a big rally, base, and then here was the leg into the zone, which was the drop. Now the bases, they usually consist of 50% candles. Not all the time, but they usually consist of small candles like this, like this, like that, like that. See how like they're base candles. They're not big candles like this or this. Those are imbalances. This is the demand and the supply taking control. That's the leg out that we want to see. So I don't want your guys' eyes to go to these demand zones the bases like this or like that. I want your eyes to see this. Let me put on a tool. I want your eyes to see this move and these moves and this move. That's what I want your guys' eyes to see. It's going to take time to see it, but you're going to slowly develop it. I'm going to help you with it. So there's nothing to worry about it. It's a very simple concept to understand, and it's going to take a little bit to get used to, but you guys will get it. So if we're going to be drawing out the demand, here we have identified a drop-based rally, one of the patterns, and now how we're going to draw them is two lines. There's really two ways. You could draw them like that, take all wick to wick. I don't advise doing that. I always advise going to the body and then to the bottom of the wick. These lines are called proximal and distal lines. So actually I should write that out. Distal and proximal. I wrote this down in the plan. I'm going to go back to it. Your distal line is always going to be the farthest line. And your proximal line, you're never really going to say the distal and proximal line, but that's technically what the term is called. So when we draw them, there's nothing wrong to draw them like that, but what we're trying to do is get the original move from where it started the move and get the bulk of the meat orders. So that's really how we're going to draw them like this. Because if we understand this was the base before the big rally, this is where it started the move. So that's the zone that we want to be marking out. All right, so same thing with supply, is you're going to have to go up and to the left to find fresh. Now I always suggest going with fresh zones is because it's going to be better quality trades, and especially starting out, you're going to be wanting to start with fresh zones, all right? Tested zones, they're okay, but it's going to be a lower probability chance. So like right now, if we were to pop open this chart, this supply right here is tested because, well, price has already been in it for a while. But if I go to you and say, where's the next fresh supply zone? One, your eyes are going to have to go up and to the left, right? Is this fresh right here? No, it's not, because look what price did. It came back, tested it once, tested it twice, and then dropped, right? So we couldn't say this is fresh. This would be tested. So if I really recommend sticking at, I only actually want you guys trading at fresh zones. It's a must. It's really going to increase your probability to winning trades. And then this would be the next supply zone up here, right? Rally, base, drop. And right here at a time, this was, if we go back to like this, at this point in time, this was a drop, base, drop. One of the supply patterns. So how we would draw that is like that. That's simple. We're just trying to go from the body to the top of the wicks. All right. I'm going to show you guys stuff that you don't want to, how you don't want to draw them soon. But in demand, here is how you would draw demand like that. So this is your proximal line, and then your distal line is always the furthest zone, and then vice versa for supply. So right here, I kind of like this tool. Right here is the distal line and then the proximal line. And then for demand, this would be the proximal line and the distal line. It really doesn't matter what they're named, but it is technically what they are called. All right. So let's go into All right, so if we're gonna, all right, so what we just talked about is zones, drop base rallies, how to draw them. So maybe you have one candle. What happens if you have one candle? Something like, I want to find one good one. Let's just quickly scroll. So say you had something like this right here. Rally, base, drop. There's nothing wrong with drawing them out like that if it's one candle. It's really up to the trader if he wants to go wick to wick. This is the only exception when it's one candle like this, is if you want to draw it from wick to wick, or if you want to continue to draw it from the body of the wick. You're going to see sometimes price comes up into the zone, then drops, and then sometimes you're going to see how price just comes up into the bottom of the wick and then drops. So it's really up to the trader. You can either draw them like that or go to the body. That's with one candle. But when it's not one candle, like something like this, right here, we're going to draw it from the top of the wick as one. We're always going to use the top of the wick for supply and the bottom of the wick for demand. And then we're always going to hug where the base camp is. This is what's happening here is a base camp before the attack happens. Before this big drop happens, think about it. This is an army that's sitting waiting. My mentor used to like this analogy. He still uses it. This is an army right here, sitting waiting for the attack. And before they attack, like this right here, they have to sit here. They have to build their base, eat. They have to get ready. That's what the institutions are doing. They're loading up right here, and then they're dropping the bomb. Then they're attacking. So we want to get to the origin of the drop and to get to the meat of the orders. All right. So we deleted everything right there. So let's quickly talk about zones that you wouldn't want to use. So like say something like this. You're going to be looking at these zones and be like, hey, I like this zone. Rally base drop, big drop, and you're not wrong. It's a big drop. But what I don't like about this is this right here, is that wick. Prices never would have gone up this high if there really was a lot of sellers. So what prices had to do is actually had to go up in order to find the next stack of sell orders before it dropped. Now there's, people could say that it was stop hunt, news release, stop hunt. And it very well could have been, but if we think about it, if there really was a large stack of sell orders, prices never would have gone that high. So when we draw them, we really want to be making sure that we're staying closest to the original price without these big wicky candles. Because with big wicky candles like this right here is really, there's no structure to it. If there really was demand here, prices never would have gone that low and then came up. All right. All right. So let's try to find like an example. Like say there was that big crash. Yeah, that big crash. Here's another example. I see some people drawing previous zones from way back here. This zone right here is a beautiful zone. How will you draw it? Like that. But as you can see, it's been tested, right? So would you really want to be buying at this zone again if it's been tested? And then this liquidity search. Why did price come all the way down here and come back up? Is well because there wasn't a single buy order until down here, until a big stack of buy orders before prices could rally all the way back up here. So what this wick right here did, it just cleared up the entire profit margin. So we don't have demand till way down here, which is we've just been falling. And another example, what I'm talking about as a liquidity search, is right here. I wouldn't want to draw my zone like this, not at all. Because what did price have to do before it dropped? Is look right here. It came into the supply zone. That means that prices had to rally up and search for the next big stack of sell orders before it could drop. It couldn't just drop from right here, from where those other basic candles were. It had to go up and then drop. All right? So here we're on the document, and what I did was I drew out all the supply and demand zones on this particular chart, just like in this general area right here. So just to get you familiarized with the four patterns we look for. So here was the drop in price, the base, and then the leg out, right? That's the leg out. And then this right here is the rally, base, rally. And here we have another pattern, rally, base, rally, and another rally, base, rally. And if we want to go see supply, I did the supply up here. Same thing for supply. What we want to be looking for is a rally in price, base, then a drop, or a drop, base, drop, which I have here. All right. So here is the rally. Prices, this is price rallying up, basing, then drop, base, drop. All right, so this is just a quick recap, what we talked about, any little final touches and stuff like that. So what we really did cover is what is supply and demand, the concept, price action, how to identify it, and how to draw it. Because if we understand the banks and institutions make these big moves in the market, we want to be on their side when they're buying and selling. And we never really know if they're going to be in the same spot where they bought or sold before, but we believe that we'll take a probability-based chance that they will take the same action if price comes down into that same level. So here we are on USD CAD. We can see this zone right here, rally, base, rally. And how I would want you guys to draw that is, remember, you first need to identify the big imbalance, the leg out, and then go to the base. Remember, we don't want to be hugging we want to be hugging the base to the bottom of the wick for demand and the base to the top of the wick for supply. You know, I don't want to see zones like that. What we're really trying to do is to refine it down to where the original move started of the imbalance. So right here is the zone or the area. There's never one price that all of a sudden at this number, this is where the buy orders are, and it turns. So we're trying to find areas, zones that we can take a guess, a high probability based guess that where it's going to turn. So if we know that there's demand here, well, now that we know that it's in demand, we want to start looking for buys, and that's really what the first time frame. We're going to be using multiple time frame analysis. Your first time frame is going to be to, one, identify the big picture where the banks and institutions are by drawing your supply and demand zones, and then two, identifying trend. Now trend, we're going to get into that in the next lesson, but trend is very important because if we want to be going with the trend, going with the uptrend or with the downtrend or in a sideways market, that's going to dictate how much we're willing to risk on that particular setup if we're going counter trend with the trend. Because if we're going, I'm going to get into this, so I don't want to get in too much into it this episode or this chapter. But that's the secondary primal role for our first time frame. So the first time frame is just to identify where the banks and institutions are buying and selling, and then the secondary role is to identify the trend so we know what type of trend we're trying to get into. Is it an impulsive move or a counter trend move, or is it in a sideways market and we're trying to play the range? All right. Now I always recommended going with fresh zones. I still recommend that because if it's tested, we never really know if it's going to be holding the same amount of strength. If we take an axe, so we go back to the USD, Euro USD, if this was a zone, let's draw it like that, and this was a zone. Every time, this goes for every zone, whether it works or not, because if this was a tree right here, or this was a tree right here, every time you take an axe and swing at it, it gets weaker and weaker. After so many swings at a tree, it's eventually going to fall down, correct? So here was one test, kept swinging. Here was another test for the supply. Here it came back down to the demand, took another swing, and then back up into supply, took a swing, and now we finally broke through it because there was no more buy orders. It had to fall down into the next stack of buy orders. Now, if prices came back up from here up, would we really want to be looking for shorts in this area? Well, probably not, and I wouldn't recommend it because one, it's been tested once, been tested twice, and we're most likely going to be in an uptrend or at least in a sideways market by the time we get up in here. So if you're going to be taking counter trends, we're going to get into that into the next one, so I don't want to get too much into it right now. Yeah, so I recommend staying with the fresh zones, identifying the fresh ones, and trading at the fresh zones. Not so much tested zones. That's once you get better at it, you can start doing it. You're going to get familiarized with the odds enhancers. You're going to understand how price works, and you're going to go from there. All right, something else you guys are going to have to consider too is what type of trader you're going to be. I talk about this in one of my swing trading videos or my swing trading versus day trading videos, and you guys are going to have to decide what type of trader you are. And that's going to come down to the type of lifestyle you have currently. If you're a family man, you work a job, you have kids, you have family, you have bills to pay, you play on sports teams, like you're busy, well, you probably don't have the time to be day trading or scalping, right? So maybe if you want to do swing trading, which is weekly, daily, 4 hour. It's a three time frame multiple time frame analysis. Everything that is in the Word document talks about this. And maybe you want to do higher time frames than that. So you want to do long term wealth. Maybe you're just trying to manage your retirement, so you want to do long term wealth trading. So maybe you want to look at monthly, weekly, daily. As in monthly will be your biggest time frame telling you where the banks are. Weekly is going to be your confirmation or your trend trading setups, and then your daily is going to be your entry. So we always use a three time frame sequence. But maybe if you're a person that works later at nights, maybe your time works out where you can scalp or day trade during the London or the U.S. Open, and maybe your lifestyle allows you to look at the markets for 4 or 5 hours a day. So maybe day trading, scalping is right for you. And that doesn't mean that you can't do swing trading or you can't do day trading, but you really want, as for anybody new or starting out in the methodology, I just suggest sticking with one to make it simple. Don't be looking for swing trades, day trades, scalps all at the same time, because that's going to be very confusing. And then something you guys need to consider is how many charts you need to trade. There's that old age question that people always talk about is how many charts you should trade. Should you be looking for quality over quantity? And that's going to depend on the trader. There's people that will argue saying you should only trade 2, 3, 4 charts so you get to know the pair and understand how it moves. And now that's one way to look at it, but maybe you're a picky trader, you're using supply and demand, and if you're waiting, if you don't see a trade set up for so long, that's the problem with using these small amount of charts is after 3 or 4 days that you haven't taken a trade, you're going to start looking for trades. And you're going to start forcing yourself to look for trades, and that's never a good idea. You got to be patient and wait for the trade setups to present itself and get into your bigger, higher time frame zones. All right. But then if you look for a lot of charts, you could identify those big zones and just wait for price to come in there. You're going to have a lot more opportunities, but it's going to be more chaos because you're going to be looking at a lot more charts. So you've got to find that middle ground. And if you're a day trader or scalper, you don't need to be looking at 20, 30 charts because, well, there's going to be already lots of charts in play if you're just day trading or scalping. But maybe if you're long-term wealth trading or swing trading, if you're only trading 3 or 4 pairs, how often are you really going to get a setup? You're going to get mad after a possible week or 2 weeks that you haven't gotten a setup. So that's why I suggest you looking at more chart setups, but only handle the amount that you think that you can handle and slowly go up from there. All right, so that's something that you guys are going to have to decide on for yourself. Give it a week, 2 weeks, you guys, or a month. You guys will slowly decide. It's going to be based on your lifestyle. All right, based if you're doing swing trading, day trading, scalping, or long term. It really depends on your lifestyle, and maybe you do have the time in the world. Maybe you do have 5 hours to look at the charts, but maybe just your personality doesn't work with day trading or scalping. It's too fast. You don't like it, so you move to swing trading. It's all about finding the middle ground for yourself and understanding what you can handle personally. All right. So that pretty much covers that. And you guys need to remember, we need to treat this as a business. This isn't something you just roll out of bed. That was one of my biggest problems. Is when I first started, I wasn't taking it serious. You guys heard it in the 18 interview, what that I did with them. I wasn't taking it serious. I didn't have a mentor, and it's good that you guys made this decision to come with me. You guys will be able to bounce ideas off in the chat room, talk to me. We're going to be talking on the mic all the time, having the weekly meetings, doing the review meetings. I'm going to be there for you with questions, all right? But if you guys are asking questions, everything's in the document and in the videos. You're gonna have to go back and rewatch these videos all the time. But you guys need to treat this as a business, right? You can't just roll out of bed at 6, 7, 8 in the morning one day, 10 in the morning the next, not trade the next, or decide to take a buy here this time. You guys have to be. I'm trying. I'm trying not to get pissed off because it irritates me when people have rules and then they break their rules. I'm gonna try just keeping it calm with you guys, giving it to you straight. But if you keep making the same mistake, I'm gonna get upset with you guys. It's just that simple. You guys need to put the pressure on yourself. I can't do it for you. You have to do it for yourself. Nobody else can do it. This is a solo game. That's it. Nobody cares if you win or lose. I don't care if you go up. If I go and lose, 10 grand. Do you guys really care? Probably not, right? Sure, it sucks. You may say, "Oh man, that sucks," but you're not really going home driving your car all dopey, right? So nobody cares about the money that you have except yourself. You guys need to understand that the banks and institutions are not going to roll over and just hand you money. This is a game that's serious that you're going to have to wake up, do a weekly review, daily review, monthly review, do all this, trying to up your strategy. All right, we're going to get into how to journal and all that in the future, but in the meetings. But that's fairly important. You guys need to treat it as a business and not fuck around. All right, I see you guys fucking around. I'm going to get mad. All right, but besides that, I'm going to leave you off with that. There's one last thing you guys need to do is the homework. There's the homework for today is to draw out 3 charts, any chart, any time frame in the world. It could be stocks, options, forex, futures, anything, any time frame. All I want is for you to draw out fresh supply above and fresh demand below. So if we are here at current price, I want you to go up for fresh supply, which is up here. Just draw it out. Just talk to me. What is the demand or what supply? And the demand would be down here, something like that. So that's what I want to see on your charts. I don't want to see indicators, other like a whole bunch of other more analysis. Just draw out the fresh demand below and fresh supply below. If we're going to take this in steps, I want to see if you guys are getting it. I'll review the homework and talk to you guys if you have any questions about it. And then the last thing is books. Any books that I recommend you guys reading and I want you guys to pick up, is one book called The Art of War by Sun Tzu and Mark Douglas, Trading in the Zone. Those are 2 excellent books. Mark Douglas is going to talk to you about psychology. He also has a great YouTube video series that's out there for free off our presentation. I suggest watching that. But pick up his book. I'm sure most of you guys have it by now, but if you haven't, pick it up. But then also The Art of War by Sun Tzu. It's a business book. We can relate everything into trading. I quote it a couple times in the document. Everything that everything that Sun Tzu talks about that is replicated in the supply and demand methodology if you think about it. All right. Besides that, I'm gonna let you go with that and send in the homework, and I'll see you in lesson 2. All right. Cheers.